There is a major tragedy going on in this country today. The casualty rate is 96% and leaves its victims dependent on life support systems. This disaster is called retirement. That's right, only 4% of the people who reach age 65 are financially independent and are able to retire without the help of their family or the government. The primary reason that this disaster is allowed to victimize people is that they do not plan. This Survival Guide series has been created for you so that you're not counted as one of those casualties. Hello, my name is Bob Smith.
And I'm Nancy Sellers. Thank you for the privilege of allowing us to be here with you today. We will be your guides during this Survival Guide series to prepare you for one of the most important aspects of your life, your financial future.
This Survival Guide series is produced by the Successful Retirement Planning Institute. The Institute was founded by a group of professionals who have years of collective experience in retirement planning, financial planning, estate planning, tax planning, investments, insurance, and banking.
This is one of 5 videos in our home seminar library Survival Guide series on saving and investing. The Survival Guide series on basic concepts of saving and investing was created for your financial education and focuses on giving you a basic overview of all aspects of dealing with financial planning for your future. We've created for you a time-saving, up-to-date, easy-to-follow approach to retirement planning. This Survival Guide series will help you overcome your fears of financial insecurity and your difficulties in saving for your future and your retirement. It will show you how you can save more money, invest what you have, and protect yourself from financial disaster. We've done all the work for you in accumulating data regarding the latest ideas, strategies, and theories. We've organized and summarized them to save you time so you can concentrate on your goal of financial independence. The major benefit of being able to bring this Survival Guide series to you in this format is that you can experience it and replay any section of each video seminar as many times as you want. All of the video seminars in this series are designed to help in organizing your financial life, to give you a greater understanding of your individual financial needs, and to help you determine what you must do now to assure that these needs will be met for an enjoyable future.
The overall purpose of this Survival Guide series are fourfold. First and foremost, we want you to become an educated financial consumer. The educated financial consumer is the one who will be able to get an above-average return on their investments, protect what they have, and have the best chance for reaching financial independence. You must be informed about the products and services available in the marketplace, as well as understand how these products and services may satisfy your individual financial needs. By being informed, you will be better able to cope with any unexpected difficulty that you may encounter and be able to make the necessary adjustments. You owe it to yourself to know what the alternatives are, to understand what you're entitled to, and most important, to be able to ask the right questions to make your decisions wisely. You are the only one that can chart your course on the map to financial independence. Second, we want to make available to you a simple, easy-to-follow, step-by-step approach to planning for your future financial needs, and in particular, your retirement. Retirement planning is the process of accumulating money and investments that will work for you so you don't have to work for them. It is the process of becoming financially independent and being in control of your life to do what you want to do when you want. The goal is for you to be able to build your own successful retirement plan so that you can provide for your family and eliminate the fear and uncertainty about your financial future.
Third, we want to dispel the myth that this planning process is something that only the financial geniuses and the super rich can achieve. The successful person is the one who makes the most out of what he or she has. We can assure you that this planning process is neither complicated nor difficult, but it will take some of your time. You owe it to yourself and your family to invest whatever time is needed. If you take the time to start planning now, financial independence is something that you can achieve. Fourth, we want to provide you with the motivation you need to start to develop your plan of action and instill the confidence to initiate that plan.
Don't hesitate to stop the tape in between topics, to take a break. There is a lot of information here for you to review. Also, play back parts of the tape that you would like to review again. Remember, we're here to help you become enthusiastic about the planning process and to guide you in attaining your retirement goals. Most important, this presentation is meant to be an enjoyable experience, not a drudgery. So settle back, get comfortable, leave your mind open to experience the techniques of successful retirement planning. By the way, if you're married, please listen to this video seminar with your spouse. It's important that both of you be involved in this planning process because it affects both of you for the rest of your lives. This Survival Guide series is dedicated to you and your success in retirement planning. Remember, no one will do it for you. It's up to you to start planning today, and we're here to help you every step of the way.
Each video seminar in our Survival Guide series has a specific goal in mind. In reviewing your personal survival guide on dealing with Social Security, qualified retirement plans, and professionals, our goal is to introduce you to the various aspects of Social Security, including how you contribute into the plan, as well as how to obtain the maximum benefits from the system. We will also discuss qualified retirement plans, which encompass not only the various employer-sponsored plans, but also individual retirement plans, showing you the advantages and disadvantages of each type of plan. And then we will teach some of the important elements in selecting and working with professionals. You'll learn how to ask questions and which questions are important to ask before you commit to any services. You'll also learn what to expect when dealing with such professionals as bank trust departments, certified public accountants, securities brokers, financial planners, attorneys, insurance agents, and real estate brokers.
Let's start now with Social Security. Whether you realize it or not, your government established the Social Security system as a forced savings plan in order to help you fund your retirement. You already contribute a sizable amount of money into the program with each paycheck you earn. The basic idea behind Social Security is a simple principle of savings. You contribute into the system during the years that you work, and you and members of your family receive monthly payments when you retire or become disabled, or members of your family collect benefits when you die. But here's an important point. Social Security is not intended to be your only source of income. Social Security will probably provide only 38% of your total average retirement income. It's really meant only to be a supplement to your pension benefits and personal investments that you will accumulate during your working years.
Contributions into the Social Security program come in the form of taxes. These taxes are used to pay for all Social Security benefits and part of your Medicare coverage. If you work for someone else, both you and your employer each pay almost 8% of your gross salary, up to a salary limit determined by Congress, into the program each year. The deduction might be labeled on your payslip as FICA, or Federal Insurance Contributions Act, which is the law that authorizes Social Security's payroll deduction. If you are self-employed, you pay approximately 15% of your net self-employment income into Social Security, up to the same salary limit as if you worked for someone else. The general rule is that you must work and pay taxes into Social Security in order to get something out of the program. Of course, some people get benefits as a surviving dependent based on another person's payment into the program. The amount of your Social Security benefit is based on such factors as your age at retirement, the type of benefit you're applying for, and most important, your earnings.
If you'd like a detailed personal estimate of your Social Security retirement, disability, and survivor's benefits, all you have to do is call the Social Security Administration at 1-800-772-1213 and request a form SSA 7004 PCOP1. If a Social Security office is near you, you can stop by and pick up the form and then mail it in. By filling out this form, the Social Security Administration will provide you with a report on all the money you paid into the plan, as well as an estimate on all your future Social Security benefits. It's called a Personal Earnings and Benefit Estimate Statement. If you're married, then both you and your spouse should file separate forms and request your separate earnings and benefit estimate statement. It usually takes 4 to 6 weeks to prepare, and lists a history of your earnings reported to Social Security, as well as all the benefits you're likely to receive upon your retirement from Social Security. It is important to periodically check your earnings record with the Social Security Administration because they themselves estimate that there is more than a 20% error ratio in the posting of earnings to the individual accounts. To make sure that you get proper credit, you must check your earnings record from them against your prior year Form W-2 and tax returns. There is a time limit on correcting mistakes, and the Social Security Administration is not responsible once that time limit is passed.
Before we get started explaining more about the Social Security program, we think it's important to answer the first question many people have about Social Security. Perhaps you've asked it yourself. Will Social Security be there when I need it? To answer this question, we must look at some history and also look at the underlying attitudes of our country. Some of the worries about the future of Social Security stem from the financial troubles the system faced in the 1970s and early 1980s. At that time, because of high inflation and other economic problems, Social Security was in a very serious financial condition. However, due to increases in Social Security taxes, adjustments to some benefit payments, and several policy changes, the system's financial condition has steadily improved. But beyond the mere facts and figures, the program's future should be ensured because of the broad backing that it enjoys from all sectors of American society. As a nation, we recognize the need to provide a basic level of financial support and health care for the elderly, as well as for our citizens with disabilities, the survivors of deceased workers, and people with low incomes. These goals are embedded in our country's values and are at the heart of the Social Security program.
Now let's look at when you may actually be able to receive your Social Security benefits. Remember, Social Security is not just a retirement program. You can receive payments if you become disabled, or your dependents can receive payments if you die. So, depending upon your circumstances, you may be eligible for Social Security at any age. But let's focus on when you may be able to receive your retirement benefits. If you were born before 1938, you will be eligible for your full Social Security benefits at the age of 65. However, beginning in the year 2000, the age at which full benefits are payable will increase in gradual steps from 65 to 67. This affects people born in 1938 and later. For example, if you were born in 1940, your full retirement age is 65 and 6 months. If you were born in 1950, your full retirement age is 66. Anybody born in 1960 or later will be eligible for full retirement benefits at age 67. No matter what your full retirement age is, you may start receiving benefits as early as age 62. However, if you start your benefits early, the monthly amount you will receive will be reduced based on the number of months prior to full retirement age you begin to receive your payments. The reduction will be greater in future years as the full retirement age increases. There are advantages and disadvantages to taking your benefits before full retirement age. The advantage is that you collect benefits for a longer period of time. The disadvantage is that your payment is permanently reduced.
Although many people are able to retire before age 65, some people continue to work full-time beyond their full retirement age, and they do not sign up for Social Security until later. Now, this delay in retirement can increase your Social Security benefits in two ways. Your extra income usually will increase your average earnings, and the higher your average earnings, the higher your Social Security benefits will be. In addition, a special credit is given to people who delay retirement. This credit, which is a percentage added to your Social Security benefits, varies depending on your date of birth, but could be as much as an 8% increase. If you wish to learn more about the Social Security retirement program, call or visit a Social Security office and ask for a free copy of the booklet, Retirement.
Now let's turn our focus to qualified retirement plans. Historically, these plans have provided only 15% of the total retirement income received by the average American, which means that most individuals do not take full advantage of the benefits that can be obtained from a qualified retirement plan. A qualified retirement plan means that the plan qualifies with the Internal Revenue Service as a tax-deferred retirement plan because it meets all the special requirements imposed by the IRS. Qualified retirement plans fall into three basic classifications based on who sponsors the plan. They are corporate-sponsored retirement plans, non-corporate sponsored retirement plans, and individual retirement arrangements. Both corporate and non-corporate plans are employer-sponsored, whereas an individual retirement arrangement can be initiated by any individual. Corporate-sponsored retirement plans can be further categorized into three main types of plans: pension plans, profit-sharing plans, and 401k plans.
The first plan we will discuss is called a pension plan. Now, under this plan, the employer is required each year to contribute a certain amount of money for each employee. The amount of money contributed is determined by whether the plan is a defined benefit plan or a defined contribution plan. Under a defined benefit plan, the amount of money to be contributed for an individual is derived by the monthly benefit he or she is to receive after retirement. The monthly benefit is determined by the employee's final earnings and number of years of service. The employer contributes an amount that will enable the plan to reach that required payout level. At the end of each year, the total value of the plan's investments must be reviewed and analyzed to determine that there are sufficient funds to pay all employee benefits when due. One advantage of this type of plan is that you can estimate what you'll be receiving in payouts from the plan when you retire. A disadvantage with this type of plan is that inflation can make the fixed income pension inadequate in later years. Under a defined contribution plan, instead of determining the future benefit levels in advance, the employer makes payments each year into the plan for each qualifying employee based upon a percentage of the employee's current compensation. The same percentage pertains to each employee, and the percentage of compensation is fixed each and every year.
The second type of corporate-sponsored retirement plan is called a profit-sharing plan. This name is really a misnomer because it has nothing to do with whether or not a company actually makes a profit. What it really means is that the employer can elect to contribute or not contribute on an annual basis. The percentage of contribution can vary from year to year, or even be zero in some years, all at the option of the employer.
The final type of corporate-sponsored retirement plan is the 401k plan. The 401k retirement plan is named after the section of the federal law that created it. The 401k plan is an outstanding way to build a retirement nest egg. Under this type of plan, the employer is not required to pay any money into the plan. It is you, the employee, who has the option to contribute some of your compensation into the plan. This contribution is deducted from your salary and deposited in a special account set up by your employer. It is not reported to the IRS as gross wages on your W-2, and therefore is not counted as part of your earnings when it comes time to determine your income tax. For example, if you contributed $3,000 of your $40,000 salary to a 401k plan, only $37,000 would be reported as taxable income. There is a maximum tax-free deduction which is adjusted each year for inflation. This plan provides employees with an automatic way to save for retirement while reducing and deferring taxes. Everyone should take advantage of this benefit whenever it's available. Even though the employer is not required to contribute, one of the most attractive features of 401k plans is that many companies do match all or part of the employee contributions.
With a 401k plan, you're limited to the investment options the company provides. The typical options include the employer's stock, a stock mutual fund, a fund combining stocks and bonds, or guaranteed investment contracts, also known as GICs, which are insurance contracts that pay a fixed rate of interest, usually comparable to certificates of deposit. Most people opt for the fixed rate of interest option because they believe that these are the safest investments. That could be a big mistake. Locking into a guaranteed rate sometimes isn't worth giving up the potential price gains in other investments. Over a period of time, fixed income returns may be seriously eroded by inflation. Shifting from fixed income to other investments, such as stocks, could easily double one's account in 20 to 30 years, based upon the historical returns of common stock as compared to fixed income returns. Another mistake many people make is to invest too much of their retirement plan money in their own company's stock. It's risky to have your retirement nest egg too dependent upon any single investment.
Many 401k plans do permit borrowing. Loans can be made for any reason the employer allows and are not recognized as withdrawals by the IRS because the money is scheduled to be paid back. Before borrowing against the plan, however, ask what the interest rate on the loan will be and how long before you have to repay the loan. Remember, however, that dipping into 401k funds to pay short-term expenses can put your retirement nest egg at risk. One of the most basic investment mistakes many employees make is not joining 401k plans. About 30% of eligible employees are not participating. Younger employees are particularly apt to ignore these plans. They are making a big mistake. The 401k plan is positively the best long-term investment vehicle for an employee. You get automatic savings, your contribution and its earnings are tax deferred, and you may even get free money through contributions from your employer. However small your deposit, everyone eligible should contribute to a 401k plan. If you can afford to contribute the maximum, you should definitely do so. Take full advantage of this long-term savings option before investing elsewhere.
The major disadvantage of either a defined contribution pension plan, a profit-sharing plan, or a 401k plan is that the actual retirement benefits are almost impossible to estimate. This is because the benefits at retirement are based upon how much money is actually paid into the plan each year and upon the plan's investment performance. If the performance of the investments are poor, or if you retire when the investment values are low, the benefits could be drastically reduced.
Besides corporate-sponsored retirement plans, there are non-corporate sponsored retirement plans which are sponsored by self-employed individuals for themselves and their employees. They are classified as either KEO plans, also known as HR-10 plans, or Simplified Employee Pension Plans, also called SEPs for short. Non-corporate sponsored plans are very similar in almost every aspect to the corporate-sponsored retirement plans we just discussed. One exception is that the maximum percentage of your wages that is allowed to be funded into these plans each year is less.
Before we leave our discussion about corporate and non-corporate plans, let's spend a minute to try to explain the theory of vesting. Vesting is an important term to understand. Pension benefits that the employer contributes to a plan are not completely owned by the employee until he or she is vested. Vesting is the non-forfeitable ownership of the balance of the employee's account in the plan. You can be partially or totally vested in the plan. Two methods of vesting can be used, but you must be vested in full upon reaching normal retirement age. Under the first method, 100% of the pension benefits must be vested after you have completed 5 years of service. There is no partial vesting, and if you leave the company for any reason before the 5th year, you forfeit all of the contributions made by your employer. This is called cliff vesting. The second method is called graded vesting, whereby you're vested 20% in the benefits after your 3rd year of service, 40% vested after the 4th year, 60% vested after the 5th year, 80% after the 6th year, and 100% after the 7th year of employment. If you leave the company for any reason prior to the 7th year, you will stay partially vested based on the number of years you were there. If you make contributions for your own benefit, you will always be 100% vested in the benefit derived from your own contribution, such as in the case of a 401k plan.
The last qualified retirement plan that we will discuss is the Individual Retirement Arrangement, or IRA. These accounts are set up by individuals solely for themselves or their spouse and are not dependent on any employer. IRAs were established by the Internal Revenue Service in the early 1980s to induce more people to save money for their retirement. You may invest in an IRA only if you have earned income or received alimony payments. Individuals can contribute up to $2,000 a year to an IRA. If you and your spouse both work, each of you can contribute up to the maximum of $2,000. A working and non-working spouse can add an extra $250, meaning that their maximum combined contribution is $2,250. If you or your spouse are not covered by an employer-sponsored retirement plan, you can also deduct the entire contribution from your total gross income for tax reporting purposes. Even if you participate in an employer-sponsored retirement plan, you may still be able to deduct part or all of your IRA contribution from your gross income, depending on your total salary.
Even if you cannot actually deduct the IRA contribution from your gross earnings because of being a member of a pension or profit-sharing plan where you work, you can still deposit money into your plan each year. The reason you should think about contributing as much as you can each year into your IRA is because, like all other qualified retirement plans that we have discussed, earnings on investments are not subject to taxes until taken out at retirement. Tax-deferred compounding of earnings means that your IRA funds will grow more quickly because the money you don't pay in taxes continues to generate additional earnings for you. This faster growth can make a big difference in the total value of your account at retirement. For example, suppose we were to put $1,000 in each of two investments which paid 8% interest. The only difference being that the earnings on one was taxable at a rate of 28% and the other was tax deferred. The total amount that would be accumulated at the end of 20 years would be $2,898 for the taxable account and $4,661 for the tax-deferred account. Well, you can see that the tax-deferred account was allowed to accumulate 93% more earnings over the 20-year period.
Deferring taxes on an income-earning account offers two additional advantages. By the time you withdraw the earnings, you probably will be in a lower tax bracket. The earnings would then be taxed at your new lower rate. In the meantime, you continue earning interest on your interest. Even if you're not in a lower tax bracket when you collect your earnings, you will be paying a tax liability with future dollars made cheaper by inflation. An IRA is a way to build a retirement nest egg that many investors fail to consider. More than 50% of all taxpayers that qualify for individual retirement arrangements do not take advantage of this savings vehicle. Those IRAs that remain deductible offer one of the best retirement plans available. Those that are not deductible at least enable you to build a retirement fund on a tax-deferred basis. IRAs may be opened with banks, credit unions, mutual fund companies, brokerage firms, or insurance companies. An IRA that is self-directed means that you choose how the money is to be invested. The variety of choices includes CDs, money market accounts, treasury securities, mutual funds, annuities, individual stocks, and bonds. But be careful how you invest. A common IRA mistake is to buy tax-exempt investments such as municipal bonds. Because they are already tax-exempt, no additional savings can be realized from putting them in a tax-favored IRA. And since these securities usually pay a lower yield than taxable instruments, you reduce your potential overall return.
IRAs, as well as 401k plans and other qualified retirement plans, should be considered long-term investments. The money you accumulate in them should not be used as an emergency fund. Because there are strict rules that govern withdrawal of your funds from an IRA or 401k, you may withdraw funds from your plan at any time without penalty once you have reached age 59 and a half. If you withdraw money before age 59 and a half, all the money taken out that was originally deductible or allowed to grow tax deferred will now be added to your taxable income in the year it is taken out and taxed at your current tax rate. In addition, you will pay a 10% premature distribution penalty. However, there are certain exceptions to the penalty for early withdrawals. Some of these include disability, death, or rollover into another IRA. The rules on penalties for early distribution change for the non-deductible portion of your IRA. The penalty for early distributions and payment of regular income tax does not apply to that portion of the distribution that represents a return of your non-deductible contribution. There is a special computation to calculate this portion. So before making any decision to withdraw the money from your IRA before age 59 and a half, you should seek the advice of an expert.
Just as there is a penalty for early withdrawal, there are also penalties for late withdrawals from IRA and 401k plans. You must begin to receive distributions from your IRA or 401k no later than April 1 following the year in which you turn age 70 and a half. It's certainly to your advantage, however, to defer withdrawals until age 70 and a half. The longer you wait, the more your account will continue to grow tax deferred. Even when you take money out of your IRA or 401k, the remaining balance continues to have the tax deferred status on its earnings.
There is one more hybrid plan that deserves to be mentioned. It is specifically designed for the employees of certain types of employers. If you're a teacher and employee of a nonprofit organization or government agency, you qualify for a tax-sheltered annuity or TSA. TSAs are like IRAs, except the contribution limits are more liberal. When considering what to invest in for your retirement years, it's certainly worth taking a look at 401k plans, IRAs, and other qualified retirement plans.
When looking at Social Security and qualified retirement plans, I'm sure you agree there certainly is a lot to know and think about. However, remember the fact that these two types of investments have historically only generated about 53% of the income that you should expect to receive during your retirement. So you'll have to depend a great deal on your personal investments to fulfill your objective of financial independence. And since you rely so heavily on personal investments in financial planning, an important point that you must always consider is the potential need for professional advice and management. How comfortable do you feel about setting up your investment plans and implementing them on your own? Some people are just too busy pursuing careers to devote adequate attention to making the proper investment decisions. Many people find that our current investment environment has become so complex and varied that they can no longer keep up with it. Other people may have the time, but little inclination to see to the many details involved in adequately managing and servicing an investment portfolio. Still others feel they lack the experience and knowledge required. If you feel like so many of these people, then professional management, or at least some type of professional advice, should be sought out.
The basic criteria of selecting professional assistance is simple. Ask questions. Many professionals are shocked at how few clients actually ask any questions. This may be caused by embarrassment from talking about our own investment needs, lack of knowledge about financial planning in general, or merely not knowing what questions to ask. We certainly hope that this Survival Guide series can effectively eliminate all of these excuses. Here are some general questions to ask when talking to any type of financial professional before you accept or pay for any advice or services. What services does the professional offer? What areas can he or she handle for you? Make sure that the professional can perform the services that you need. What are the professional's credentials, and how long has he or she been offering these services? Do they have the practical experience and educational background in the financial area that you need help in? Is the professional compensated for his or her services by a fee arrangement or commission? In most cases, you're better off with a fee-based professional for objective advice. Even so, always ask the professional for an estimate of what the fee will be for the services that you're requesting. Does the professional deal with other experts? A good professional always turns to other more qualified professionals for assistance when needed.
What products is the professional recommending or offering? Is the professional receiving any income directly or indirectly from the sale of these products? If so, how much is it? And how does it affect the money that you're investing? Are the products considered prudent investments? Are they legitimate? Have they been rated by investment rating services? Are the returns on the investments too good to be true? Who are the professional's other clients? Can you speak with any of them? References are always a good way to check how the professional has completed his or her work in the past. Along those same lines, can you see samples of the work that the professional has prepared for other clients? If it pertains to the work that you are asking the professional to do, will the professional give you a written analysis of your finances in order to support any recommendations? Has the professional ever been sued by any clients? But don't just rely on the word of the professional. Check with the Better Business Bureau, professional associations, and so forth. If the answer is yes, go a step further and find out what the complaints were and what the outcome was. Have disciplinary actions been taken against the professional by the government or any professional organizations? Clearly, if there have been actions taken against the professional, you might be better off going to another.
Who are some of these people who you can go to as professional advisors? The most important categories are bank trust departments, certified public accountants, securities brokers, financial planners, attorneys, insurance agents, and real estate brokers.
First, let's talk about trust departments that you can find in your local bank. Most people think that only the very wealthy are clients of bank trust departments. That's not the case at all. Bank trust departments offer different levels of service to individuals as well as small businesses. The level of service is something that you choose depending on what you need and want. By law, bank trust departments cannot charge you a commission. Therefore, they provide a more objective view in their advice to you. They make their money by charging on a fee basis for their specific services. Trust departments offer a wide variety of diverse, personalized services in order to compete successfully in the large financial services industry. And they work with other professionals to enhance the fulfillment of your needs. Let's look at some examples of the different levels of service that bank trust departments offer.
The first most basic level is a custodial relationship whereby the trust department acts only at your direction. This service includes collection of income, safe custody of assets, and detailed record keeping. In most cases, trust departments refer to this as their reaction services. The next level can be referred to as inactive services or agency accounts. Trust departments perform more complex duties, some at your direction and some using their own judgment, providing you with professional guidance when you need it. This type of service would include everything at the first level and also professional guidance, tax reporting, and automatic cash reinvestment so your money works harder for you.
Level 3 is a trust department's first level of proactive services or managed accounts, where the trust department acts for the benefit of their customer at the bank's discretion. These services include the same as Level 2, but with the addition of management of investments. Level 4 would be the highest level of service, in which the trust department performs trustee duties and can arrange to perform nearly any financial service that you request. The services that are available are the same as Level 3 with the addition of protection of beneficiaries, payment of bills, and flexibility of agreement. Bank trust departments also perform corporate trust services for businesses in regard to their retirement plans. They can establish and administer employee benefit plans, pension plans, profit-sharing plans, and 401k plans. They also provide individual financial planning and asset allocation modeling. They can even set up and maintain your self-directed IRA account. So, as you can see, it would be a mistake to overlook a bank's trust department as a source of professional advice and management when seeking someone who will be objective in helping you with your investment needs.
Now let's look at certified public accountants, commonly known as CPAs. As professional members of the American Institute of Certified Public Accountants, CPAs are trained professionals in the nuts and bolts of finance. They are also licensed and regulated by state boards, which tend to raise the level of professionalism. A CPA can function as a consultant, coordinator, or sounding board, and can be more objective than some advisors who sell financial products. They can be particularly valuable in addressing income tax strategies, which is possibly the most complex and important area of retirement planning. Moreover, most tax considerations are highly individualized. An advisor familiar with your special circumstances can be a lifesaver. From an overall tax planning standpoint, CPAs can be invaluable when it comes to assisting you in minimizing income taxes, maximizing after-tax return on investments, timing of retirement or other income distribution, income tax return preparation, and estate planning.
Like all other highly trained professionals, you must pay a price for their expert advice. So before looking for a certified public accountant, ask yourself if you really need this level of expertise. If most or all of your income is derived from a salary, you can probably handle your taxes alone. Should you want someone to do your tax return, you could use a tax preparation service such as H&R Block. But if your finances are complicated or likely to get that way soon, or you need help in learning the possible tax implications of your financial plan, you can benefit greatly from hiring a more experienced tax advisor, such as a CPA, for the preparation of your returns and year-round tax planning advice.
When you interview prospective tax advisors in person, take along copies of your most recent federal and state income tax returns. The forms and a brief description of your financial life should provide enough information for the professional to give you a rough estimate of the fees he or she will charge to help organize your finances and prepare your tax returns. During your interview, describe the most frustrating aspect of your taxes and make sure you listen for reactions and advice. If you don't understand what's being said, or you feel in any way intimidated or uncomfortable with the advice, find yourself another CPA. For more information, contact the American Institute of Certified Public Accountants, Personal Financial Planner Division at 1211, that's 1211 Avenue of the Americas, New York, New York, 10036. Or call area code 212-596-6200.
The next area of professional advice that we're going to discuss centers on securities brokers. Securities brokers can sell you virtually any type of investment, including mutual funds, annuities, and of course, individual stocks and bonds. There are many factors to consider when choosing a securities broker because not all brokers are alike. There are full-service brokers, which offer an array of services, and there are discount brokers, which may offer few or no services, and the cost of commissions may vary drastically between the two. But a good broker will be worth far more than what you pay in commissions. The only problem you'll have is finding a good one. Just as you shouldn't try to choose a doctor from the phone book, it's not a wise move to phone a brokerage firm and ask to talk to whoever is available at that particular moment. So where do you begin to look? Well, your best source is probably a referral from a friend who's comfortable with his or her own broker and has made some money in the market by following that broker's advice.
When you do first call a broker, do it after the market closes so that he or she will have some time to concentrate on your personal situation. Make sure you describe your investment goals to the broker and be realistic and honest about how much money you have available to invest. Then listen to the broker's comments. Just because you've taken some time to talk doesn't mean that you have to invest right away. In fact, it would be a good idea to ask for some recommendations so that you could keep track of their performance. In this way, you can check on some of the advice that the broker is giving and develop a confidence before you invest your money. And don't worry if you miss out on a few good investment choices. There will always be other opportunities.
Sometimes you'll get a broker calling out of the blue to solicit your business. Brokers, like other salespeople, often cold call to prospect for new clients. Be aware that you have no obligation to even listen to these brokers. But if you have the time, it wouldn't hurt to keep track of their recommendations to see how good they are. Also, it's worthwhile to meet a broker in person before doing business. It may be somewhat inconvenient, but after all, you're going to establish a relationship based on trust and understanding. So it's always smart to actually see who you're going to be dealing with. Also, when you do open a brokerage account, you and the broker should have a clear understanding not only of your personal investment goals, but of who has the final say in making an investment decision. You should never establish what is called a discretionary account at a brokerage firm. This means that the broker has the right to buy and sell for your account based solely on his or her judgment. you should always maintain the final approval for any trade made in your account.
There is one more thing to get straight right from the start: commissions. Most brokerage firms will negotiate commissions. That means the broker often has a certain amount of discretion over what is charged for each trade. If you have a large volume of trades or have a large dollar account, don't be afraid to ask for a reduction in the commission rate. On the other hand, if you're just starting out with a small investment, you really don't have the leverage to demand huge savings, but it never hurts to ask. While you should try to keep track of a broker's recommendations for a while before trading, you can't expect to be receiving this free advice for long periods without doing some business with a broker. Remember, a broker only makes money through commissions when you actually do a trade. You don't have to act on every recommendation you hear, but eventually you'll have to give the broker some business if you expect him or her to continue to give you recommendations. When you begin to do business with a brokerage firm, you should keep track of all your confirmations and monthly statements. It's your responsibility to compute your gains and losses at the end of the year. Although most firms will send you statements summarizing your transactions, you should always check to make sure you bought or sold at the price you asked when placing the order.
So, what exactly can you expect from your securities broker? The first and most important thing is honesty. This means an easy-to-understand, truthful explanation of the risks involved in any investment before you buy. You should also expect the broker to find securities that fit into your overall investment plan, not just give you the latest hot stock tip. You should expect complete, understandable information, including research reports or a prospectus when you're buying a security. You should also expect the broker to notify you immediately if any new information has come out on a security that you've purchased. Remember, the broker works for you. You are paying his or her salary. Don't be afraid to expect or demand the service you're paying for.
The bond that holds together any successful broker-customer relationship is trust. If you're uncomfortable in any way with the manner in which your account is being handled or the securities your broker is recommending, you should immediately take action or make a change. If you feel you're having trouble with your account, first speak to the supervisor. And if you don't get satisfaction, complain to the Office of Consumer Affairs, Securities and Exchange Commission, by writing to them at 450 5th Street, Northwest, Washington, D.C., 20549, or by calling area code 202-272-7440. Don't ever be afraid to speak up. There are over 400,000 registered stockbrokers in the United States. You should certainly be able to find one that is a match for you and your investment needs.
Now let's take a look at financial planners. You may want to consider working with a professional financial planner to help design a workable retirement plan for you. There are two basic types of financial planners: commission and fee-only planners. Commission planners are traditional planners who will advertise that they offer comprehensive financial plans and advice for free. But as you know, nothing really is for free. They make their money from commissions on the products that they sell you. The major problem with these planners is their possible lack of objectivity. With commission-based products to sell, they may advise you to spend more money than is necessary. Whenever employing commission planners, do not act on their investment advice immediately. Instead, compare their recommendations to other investment products or seek advice that confirms what you've been told. Fee-only planners are, in most cases, a better choice for retirement advice. Instead of charging you commissions on investments, fee-only planners charge either hourly or daily rates to help you with specific investment problems or help you put together your overall retirement portfolio. The major advantage is that with no commission to earn, they tend to be more objective with their advice. They don't sell investments, but they do often make recommendations of specific financial products. Their impartiality can be costly, however. Fees vary widely from $50 to $200 an hour or from $1,000 to $3,000 for 6 months of detailed planning. But sometimes these fees are inexpensive when you consider the long-term nature of your investment plan. For a list of fee-only planners, write the National Association of Personal Financial Advisors at 1130 Lake Cook Road, Suite 105, Buffalo Grove, Illinois, 60089, or call 1-800-366-2732.
The right financial planner can bring together all the aspects of a successful investment strategy and focus these in on your funding goals. He or she can also suggest ways to correct mistakes you may have made in sporadically trying to plan on your own. But don't expect this person to take control of every aspect of your financial plan. Most financial planners do not prepare tax returns or give legal advice. An astute pro will be able to analyze what you need to develop the right plan to achieve your desired financial picture. The operative word here is astute. Anyone can call themselves a financial planner, and thousands of undertrained people do. How do you pick a good financial planner? Well, you can answer this question in one word: carefully. The best way to choose a financial planner is to shop around until you find someone who both meets your needs and is professionally competent. Before you decide, make sure you ask some, if not all, of the questions that we gave you when starting our discussion on choosing professionals.
To find a genuinely good financial planner, start by asking all your other professional advisors for names of planners whose work they respect. Next, look for credentials. A certified financial planner or a charter financial consultant must pass a series of rigorous exams and have 3 or more years in the field. When you interview a financial planner, always ask about his or her background and experience. Many so-called financial planners are insurance agents or stockbrokers who use the label to attract business. Many states require specific disclosure to be made of the credentials of financial planners. They include how a planner gets paid, his or her experience, whether he or she has a financial interest in any investment they sell, and if he or she has been disciplined by federal or state agencies or by self-regulation groups. If this disclosure is not required in your state, ask these questions anyway. Financial planning is not a highly regulated field like some other professions, so you have to be careful in deciding whom to trust.
Our next classification of professionals include attorneys. A lawyer is a highly trained professional who qualifies to assist you in handling your financial resources, property, housing arrangements, estate planning, and a variety of family affairs. Some lawyers concentrate in one or more of these areas, and with their academic and legal training, are able to guide you when you begin planning for retirement. It's wise to obtain as much expert legal advice as possible to assure yourself of a problem-free retirement. Correct planning decisions will ensure your independence, security, and peace of mind.
One way to choose a lawyer is to find a satisfied client. You may be able to get a lead by talking to your family and friends. Another way is to check with your banker for the names of a few reliable attorneys. You can also call your local bar association's sponsored lawyer referral service. Once you have at least 3 names, call the lawyers to arrange face-to-face consultations, which should be free or cost only a small fee. At each interview, describe your legal problems or needs. Then ask the lawyer about his or her credentials and to give you a brief explanation of how your situation would be handled. Politely but firmly, inquire about the number of cases like yours the lawyer has worked on and their outcomes. Be sure that the lawyer you choose is familiar with the aspects of your particular problem, since lawyers will most likely specialize in certain areas of the law. Also, verify that the lawyer has worked in your location for a number of years. This is critically important in real estate law, since state and local ordinances vary widely.
Lawyers often pass down much of their work to younger associates in the firm. Find out who will be ultimately responsible for your legal work, and be sure to review that person's knowledge and experience. During your initial interview, a lawyer should volunteer information regarding his or her fees. If not, ask, and if a lawyer hesitates too much, find another. Expect to be quoted rates between $50 and $250 an hour, depending on where you live and the complexity of your case. If you believe that a particular lawyer's fee is too high and you cannot afford it, you're free to solicit another lawyer whose charges may be more modest. Always ask up front. To save money, Consider legal clinics. Check with your state agency for the ones in your area. Some routine matters can be handled by an inexpensive legal service chain. You can also get assistance on routine matters by using a prepaid legal service group. When your legal problems escalate, however, make sure you turn to a skilled private practitioner. Ordinarily, a lawyer charges on the basis of the amount of time he or she spends in serving you. This includes the time spent speaking with you in the office and on the telephone, looking up the law, preparing legal documents, writing letters, and negotiating with others on your behalf. Sometimes a lawyer sets a flat fee for a certain type of work, such as a real estate closing or drawing a will. At your first contact with the lawyer, you should ask how much the charge will be in your particular case and what the method of payment will be. Different scenarios might include payment in advance, or a deposit with a balance to come at the conclusion of the work, or periodic payments. Knowing the expected payment arrangement in advance will avoid the possibility of disagreement and any confusion later on.
After the interview, assess your own reaction. Did the lawyer inspire confidence? Did you feel free to ask questions? If for any reason you're dissatisfied, move on to the next prospect. In evaluating any lawyer, always take these items into consideration. Is he or she competent, forceful, honest, knowledgeable in the field, up-to-date, discreet, independent, compassionate, respected, communicative, and reasonably priced?
Now let's look at insurance agents, concentrating on what service an agent is supposed to perform and the types of agents you may come in contact with. The insurance agent's job is to understand your possibility of risk of loss in different areas and suggest to you insurance policies that will cover these possible losses. A creative agent will know what kind of questions to ask, will listen carefully to your answers, and then assist you in selecting coverages that are both appropriate to your circumstances and affordable. There are three types of insurance agents. An exclusive agent is an individual who sells the insurance product of only one insurance company. Now, they should be quite knowledgeable about the products offered by that company, but will not offer you policies from other competing companies. An independent agent is one who sells insurance for two or more companies. They run their own business and may offer a wide range of policies from different companies. Because they're independent, they normally do not offer insurance coverage from a company that relies only on exclusive agents. An insurance broker normally employs a number of agents and handles a number of products from a variety of insurance companies. An insurance broker offers you the largest variety of insurance companies to choose from and usually has broader expertise. Some specialize only in helping businesses with business-type insurance.
Some individual agents have the designation CLU, which stands for Chartered Life Underwriter, or CPCU, which stands for Chartered Property Casualty Underwriter. The CLUs and CPCUs have to pass rigorous exams in order to earn these professional designations, and usually have much more knowledge than agents without this training. Generally, you should try to work with an independent agent who has access to the products of many different insurers, because they usually have the ability to find the appropriate coverage for the most economical costs. Remember, never buy anything immediately. Rather, go to several agents and compare similar products. And always review insurance plans with your other advisors, such as your attorney and your CPA.
Our last classification of professional is the real estate broker. All real estate brokers work on a commission basis, and almost all good brokers specialize in either residential properties, which include houses, townhouses, condominiums, and apartments, or commercial properties, which include office and retail, or industrial properties, such as warehouses and manufacturing facilities, or farm properties, which include vast tracts of vacant land. When choosing a real estate broker, make sure he or she specializes in the type of property you're looking for. By doing this, you should be getting someone who is well informed about all available property for sale or rent in your area in that particular real estate classification.
You should also be aware that there are selling or listing brokers. That is, those real estate brokers who represent the seller or owner in a real estate transaction. They are the fiduciary agent of the owner, and as such, should be looking out solely for the best interest of the owner. If a broker represents a buyer or prospective tenant, he or she is referred to as a buyer rep or a tenant rep, and is the fiduciary agent of the buyer or tenant, and should be looking out solely for the best interest of that buyer or tenant, even though the commission is traditionally paid by the owner or seller. Sometimes a broker may act in a dual capacity, both for the buyer or tenant and the owner or seller. He or she cannot do this, however, without the knowledge and consent of both parties to the transaction. You must be very careful in this type of dual agency transaction. Unless you have some knowledge in real estate and are a skilled negotiator, you should always have an independent real estate broker advising you and representing your sole interest in the transaction.
Real estate brokers, like security brokers and insurance brokers, are highly regulated by the state government and must pass required state tests in order to be able to deal in real estate matters. And similar to our discussion on the selection of other professionals, always shop around for someone who is knowledgeable, competent, honest, independent, respected, communicative, and a good negotiator. Most important, when you're deciding to use any type of professional, remember it's your money that you're investing, and it's your goals that have to be reached. Only you can decide whether or not you need professional help or advice, and whether or not you should follow any advice that is given. You can and should get as much help as you need, but it is definitely your decision to make on how to invest for your future.
You've just been made aware of some important elements needed to educate yourself as to the process of becoming financially independent. We've told you something of what our Social Security system is all about. We've also looked at the benefits that can be obtained by investing in a qualified retirement plan, either through your employer or on your own. And finally, we've introduced you to the various professionals that you can go to for advice in helping set up your retirement plan or helping you keep it on the road to success. Granted, you've only taken one step in educating yourself in understanding the total concept of retirement planning. But remember, no matter how far the journey or how difficult the trip, it all starts with that first step.
This educational process never ends. You should continue to read and learn about financial matters in general and the investments that you're considering or have already purchased. If there's something you don't understand, always seek the advice of a professional. And above all, always be observant and ask questions. Remember, your financial plan, your retirement plan, is always a dynamic plan. That is, it should be changed as circumstances in your life as well as circumstances around you change. Tax laws are constantly changing. There are always new investments that become available that might better fit your most current circumstances. And certainly your personal situation will be forever changing as you go through life.
You should never put together a retirement plan and cast it in stone to be followed forever. It should be reviewed constantly, certainly at least once a year, or any time your personal situation changes. That's why it's so important to always keep abreast of what's going on around you in the financial world in order to be able to shift gears when you need to.
It has been our aim in this video seminar, as well as all the video seminars in our Survival Guide series, to provide you with the basic knowledge and motivation that you need to begin to develop and continue to implement an action plan for your retirement. A successful retirement plan will not happen on its own. Your success in making a retirement plan work will depend entirely on you. You must start now to follow these simple steps. First, take control of your family's lifestyle expenditures and improve your family budget. Second, maximize your earning potential. Third, set up your emergency fund, investment fund, and special purpose fund. Fourth, reduce your debts. Fifth, determine your investment strategy and start investing for your retirement. Sixth, don't be afraid to get professional help from bank trust departments, CPAs, attorneys, stockbrokers, financial planners, insurance agents, or others. Seventh, continue to read and review the financial sections of newspapers, financial planning magazines, newsletters, and other publications. to keep up to date on current conditions which may affect your plan. 8, make sure you're adequately insured for life, health, disability, property, and personal liability risks. 9th, begin estate planning by establishing a will. And finally, 10th, don't hesitate to review this video seminar to help you stay on the right track.
As we mentioned in the beginning of our presentation, this is only one video seminar in our Survival Guide series, which is dedicated to increasing your knowledge in all aspects of financial planning. The other 4 tapes in our seminar series include your Personal Survival Guide on Planning to Save, your Personal Survival Guide on Investments, Part 1, your Personal Survival Guide on Investments, Part 2, your Personal Survival Guide on Protection.
On behalf of the Successful Retirement Planning Institute, we want to thank you for having us with you to discuss this very important topic of retirement planning.
Remember, a person who plans has the best chance of retiring to a worry-free life. They have the best chance of being able to have the time and money to do what they want, when they want. Invest the time to establish your plan, implement your plan, and constantly review your plan.
Make this investment in yourself. You deserve to be financially independent and have a successful retirement, and you owe it to yourself and your family to make it happen.